Arrowhead is a clinical stage biotech focused on RNA interference therapies. They've got programs targeting liver disease, cardiovascular disease, and obesity. Here's why this stock could skyrocket. When a biotech company announces successful phase 3 trial results, the stock can double or triple in days. Not because of narrative, because of actual regulatory milestones that lead to FDA approval and revenue. The obesity market alone is projected to hit $100 billion by 2030. Everyone's talking about Ozempic and Wegovy, but there are over 120 next-generation GLP-1 drugs across 60 companies, and Arrowhead has programs in this space. Plus, they've got partnerships with major pharma companies. They've got validated technology in RNA interference. This isn't some speculative science. This is proven technology with multiple shots on goal. Here's the catalyst that could make this stock explode. Arrowhead has multiple programs in late-stage clinical trials. Any one of them reporting positive results could send the stock skyrocketing overnight. Think about what happened with other biotech companies when they announced positive trial results. Stocks go up 50%, 100%, 200% in a single day. This is growth investing with actual catalysts, not just speculation. While AI stocks are priced for perfection with no clear path to profitability, biotech stocks like Arrowhead have clear milestones. Phase 2 results, Phase 3 results, FDA approval. Each one can trigger massive revaluations. You're getting explosive growth potential for a fraction of what you'd pay for AI stocks with predictable milestones. And here's the best part. The market hasn't priced this in yet. While everyone's distracted by AI, Arrowhead is quietly announcing multiple programs on the way to approval. When any of those results hit, the stock is going to move fast. That's why ARWR is the one stock about to skyrocket. Now let me show you the other 5 stocks positioned for the macro tailwinds happening right now. Let's start with AIG, American International Group. The Fed created an environment where insurance companies struggled. Low interest rates crushed their investment returns. Insurance companies make money in 2 ways, underwriting premiums and investing those premiums. When rates were zero, that investment income disappeared. But now rates have normalized. Insurance companies can actually make money on their float again. Plus, there's a massive CapEx boom happening, not just in AI, but across the entire economy. Companies are building factories, data centers, infrastructure. Boeing just increased their plant by 50%. We're seeing massive build-outs everywhere. Property insurance, liability insurance, workers' compensation, cybersecurity insurance. The conversation around infrastructure isn't just about building it, it's about protecting it. And insurance companies are the ones who provide that protection. AIG is positioned to benefit from normalized interest rates and increased infrastructure spending without any of the risk in AI stock hype. While everyone is paying 50 times for AI software companies, AIG is sitting at a massive discount. AI provides the insurance that makes all of this infrastructure possible. This is how you play the infrastructure boom without getting exposure to the bubble. Now let's talk about BMY, Bristol Myers Squibb. Here's what people don't understand about pharmaceutical companies. They got destroyed during the zero rate environment. Why? Because pension funds and insurance companies that normally buy pharma stocks for yield couldn't get that yield. They had to chase growth stocks instead. So pharma got left behind, abandoned trading at single-digit multiples while growth stocks went to the moon. But now rates have normalized. Yield matters again, and pharma stocks that pay dividends are suddenly interesting again to institutional buyers. BMY is trading at 8 times earnings with a 5% dividend. Everyone's scared of their patent cliffs, but they've navigated patent cliffs before. They've got pipeline products in obesity, oncology, and immunology. Here's the other piece. The conversation right now is all about AI taking jobs, about unemployment ratcheting up even 2 to 3 points, about society being terrified of what's coming. When society is under stress, pharmaceutical demand doesn't go down. It goes up. Mental health prescriptions increase. Chronic disease management becomes more important. People under economic stress get sicker. You're getting paid 5% to wait while the macro setup improves and pharma demand increases. The Fed created an environment where nobody wanted boring pharma stocks. Now the Fed is creating an environment where pharma looks attractive again, and societal trends are increasing demand for their products. Now let's talk about BIDU. Baidu. This is pure macro contrarian thinking. Everyone's talking about AI capex in the US, $320 billion in 2025, $530 billion projected for 2026. OpenAI just raised $100 billion, the largest private fundraising round in history. Sovereign wealth fund money, Saudi Arabia, UAE, Norway. But here's what nobody's talking about. China is doing the exact same thing. We're in an AI race with China, after all. China is spending massive amounts on AI infrastructure, and they're not going to stop. The Chinese business model is based on volume and employment. They're not going to abandon their 5-year plans. They're not going to stop investing in technology leadership. Baidu is China's AI leader. They dominate search with over 70% market share. They dominate maps. They're investing heavily in AI and autonomous driving. Their Apollo autonomous driving program is one of the most advanced in the world. Here's the opportunity. You're getting China's version of Google at a massive discount to US tech valuations. All the geopolitical fear has crushed their valuation, but the fundamentals are still there. While US AI stocks trade at 50 times sales, Baidu trades at a fraction of that for similar AI exposure. Yes, there's geopolitical risk. Yes, there is regulatory risk, but that's why it's cheap right now. If you believe China remains a major player in AI, Baidu is massively underpriced. This is the contrary in play. Everyone's scared, and when everyone's scared, that's when the opportunity exists. Let's talk about BKNG, Booking Holdings. Here's what the Fed's policies did. They pushed asset prices higher. The people who owned assets got rich. The S&P went up. Real estate went up. But real incomes for workers barely moved. Now things are shifting. Real incomes are starting to accelerate. And when real incomes accelerate, consumer spending shifts from necessary to discretionary. Travel is the ultimate discretionary spend. And Booking Holdings owns the dominant platforms. Booking.com, Priceline, Kayak, OpenTable. The COVID lockdowns created pent-up demand. People spent 3 years stuck inside. They're not going back to that lifestyle. The experience economy is exploding. When people have more disposable income, they don't just save it. They spend it on experiences, trips, vacations, dinners out, and Booking captures all of that. BKNG is positioned to capture increased consumer spending as the economy shifts from asset inflation to real income growth. Plus, they've got massive free cash flow. They're buying back stock aggressively, and they're trading at reasonable valuations compared to tech stocks. This isn't a bet on AI. This is a bet on human behavior. People want to travel. People want experiences. And as their incomes improve, they're going to spend on exactly what Booking provides. Finally, let's talk about JAZZ, Jazz Pharmaceuticals. Jazz specializes in 2 areas: sleep disorders and oncology. And both of these are massive growth markets that have nothing to do with AI hype. Let's talk about sleep first. The conversation right now is about AI disrupting jobs, about unemployment potentially rising, about societal stress and anxiety. When society is under stress, sleep disorders explode. Insomnia increases. Anxiety increases. People can't sleep, so they turn to pharmaceutical solutions. Jazz has dominant positions in narcolepsy and sleep disorder treatments. These aren't optional medications. When you can't sleep, you need help. And Jazz provides that help. On the oncology side, cancer doesn't care about the economy. Cancer doesn't care about AI. Cancer treatment is non-discretionary healthcare spending that continues regardless of economic conditions. Jazz is a consistent cash flow generator in therapeutic areas with structural demand growth. While tech stocks are priced for explosive growth that may never come, Jazz is generating consistent cash flow in areas with steady growth. Plus, as society becomes more stressed, as work-life balance deteriorates, as AI creates economic uncertainty, Jazz is perfectly positioned for this trend. You're getting a recession-proof business in growing therapeutic areas at reasonable valuations. This is the anti-hype play. Boring, steady, profitable growth in markets that aren't going away. Now here's how I think about managing risk with these positions. The volatility index is like a traffic light. When the VIX is calm, the light is green. The institutions are comfortable. Risk on. When the VIX spikes, the light turns red. The institutions are buying insurance. Risk off. Time to go to cash. The goal isn't to make money every day. The goal is to avoid the one bad day that wipes you out. If we can sidestep the 30% crash, the math of compounding takes care of the rest. These 6 stocks aren't momentum plays. They're not going to all triple overnight, but Arrowhead could, and the others aren't going to crater when the bubble pops. They're positioned for macro trends that are just beginning, while everyone else chases the end of the AI hype cycle. So there you have it. 6 stocks. ARWR is the one about to skyrocket on clinical trial catalysts. But then you've got AIG, BMY, Baidu, BKNG, and Jazz, all positioned for macro tailwinds. Insurance benefits from normalized rates and infrastructure spending. Pharma benefits from yield mattering again and societal stress. Biotech offers growth with actual catalysts. China offers AI exposure at a discount. Travel captures consumer spending recovery, and specialty pharma plays structural demand growth in sleep and oncology. You're diversified across sectors. You're positioned for macro shifts. You're not paying bubble valuations. Do your own due diligence. Size your positions appropriately, and position yourself for what's actually happening in the macro environment. not what's trending on social media. If you want to see exactly how I'm managing risk with these types of positions, hit that subscribe button and you'll see a free course for how to find the next NVIDIA without gambling on startups in the YouTube post section. I'll show you the system, the indicators, and how to buy your first stock, even if you've never invested before. Thanks for watching. Smash that like button. Drop a comment on which stock you're most interested in. Click that first link in the description to trade with me at stockscommunity.com, and I'll see you in the next video.